Hi, everyone, and welcome to our annual nonprofit tax update. A couple of quick housekeeping items before we begin. We will be sending these slides out after the presentation, and we do have the option for you to send questions to us in the chat. We will address any questions at the end after we're through talking through our presentation. So without further ado, I think we'll jump right into it. So I'm Dan Sweeney. I'm a tax director here. I work in our nonprofit tax division. I'm in our Omaha office. And Hannah, if you want to say a few words about yourself.
Hi, everyone. I'm Hannah Goscha, tax manager here at LUTS. I actually work remotely out of our Colorado office of one. Okay, and so today we're going to be talking about 990s. I'm going to give a quick overview of 990s, go through some of the filing requirements, if you can file a 990EZ or the 990N, best practices for tax-exempt organizations, and then we'll chat through unrelated business income tax, or UBIT, and some of those specifications, and then Dan will talk through tax updates for nonprofits and industry annual trends.
And it's also worth mentioning that midway through, we will have a polling question for CPE for those who want CPE credit. So I would listen very intently because from what I understand, that question is going to be quite difficult.
Okay, so 990 overview. So we have two different types of tax-exempt organizations. The first is a public charity who they receive their public support from a broad base of donors. Typically, this is going to be revenues from donations, membership dues, and program service fees. Generally, they do not pay any income tax unless they have that UBIT income that we'll talk about a little bit later. And unlike private foundations, there's no requirement for a certain amount of expenditures that they have to spend each year. Then we have private foundations, which these are typically foundations that are set up by a single donor or a family. They continue to fund the private foundation over its life. They are taxed on their investment income at a flat rate of 1.39%. They're required to make annual distributions of 5% of their average fair market value of assets. And there's also excise taxes that apply if those annual distribution requirements are not made. We'll talk a little bit more about that a little bit later. So common types of public charities, most common is your 501c3. These are your religious organizations, anything that's set up for charitable or educational purposes. And then some ones that you see a little bit less often are your civic leagues and welfare organizations, labor unions, business leagues, and then your social and rec clubs. Those are all tax exempt, but have different rules based on their 501c status. And then we have private foundations. These are primarily your grant-making organizations funded by a single donor, and private operating foundations such as a museum that act like a business but are tax exempt in nature, and those are still classified as a 501c3. So then the biggest test for public charities is the Schedule A public support test. If we fail the test, we will no longer be classified as a public charity and would be reclassified as a private foundation where you're subject to those different taxes. So very important, we pass the public support test. The first test is the Part 2 test. This is when an entity receives a substantial part of its revenue from governmental entities or the public. So they're going to primarily receive contributions that are going to be funding them from the public. The other test is the Part 3 test, which this is where you're going to factor in your program service revenues. So they receive 33 1/3% of their test from contributions and those program service revenues that are related to their tax exempt purpose. The Part 3 test also has an additional 33 1/3% test related to investment income, where they cannot have more than 33% of their income coming from investments or UBIT. And you can switch between these two tests each year, depending on which one will help you pass that 33 1/3% test. So this next slide here kind of compares the two tests about what you're factoring in. So like I said, the Part 2 test, you're receiving all of your, or primarily all of your revenue from contributions from the public. while the Part 3 test, you factor in those program services. And then they each have a limitation on the donor contributions. So with the Part 2 test, limits the contributions from each person by the amount over 2% of the total income over a 5-year period. They do get 100% of the donations from government units or other publicly supported charities, counting in towards their public support percentage. And then for the Part 3 test, we have this concept of disqualified persons and non-disqualified persons. So disqualified persons are going to be your board members or anyone related to your board members. And those donations do not count at all towards the public support test. And then anyone who contributes that is a non-disqualified person, they get limited to the greater of 5,000 or 1% of the current year income. So basically what all that means is Schedule A is the most important schedule on the Form 990. It determines your public support percentage for the year, and if you continue to stay classified as a publicly supported organization. And it can get very convoluted with these different tests. So just ask your tax advisor or ask us if you have questions on this, as Schedule A can get pretty complicated. And then Schedule A, Part 4 and Part 5 are going to be for your supporting organizations. So supporting organizations do not complete Part 2 or 3 because they are there to carry out the mission of their supported organization. So they don't have to go through the hoops of being a publicly supported charity because they are there to support the supported organization, and they can be classified as a type 1, 2, or 3 based on the board influence and how they are functionally or non-functionally integrated with their supported organization. Schedule B is going to be your next most important schedule. This is going to be the schedule that lists those donors that we just talked about. This is redacted for public disclosure purposes, so it only goes to the IRS. They would like to see who is donating to the organizations. If it's truly anonymous, you can put that on Schedule B, but if you do know the donor, you should be disclosing who that donor is. Dan will talk a little bit later about some controversy over Schedule B and the disclosure of those donors. Any donor over 5,000, or if they pass the Part 2 test on Schedule A, they can have a higher threshold of just disclosing donors over 2% of the income on the tax return. Schedule C discloses all of your lobbying activities. And Schedule D is supplemental information that you'll see on almost every 990 that just gives some further detail to the financial statements that are disclosed on the 990 itself. Then there's several other schedules. The reason that you're required to file these are dependent on the first couple pages of the Form 990, where it asks all the questions about the required disclosures about different activities that you have going on at your organization. Some of the most common ones you'll see are Schedule J, some further detail on the compensation of officers that's disclosed. And then we have Schedule O, where you can disclose any supplemental information that you would like for the public to see. And then Schedule R is any of your related organizations and any transactions between the two. Like I alluded to earlier, the 990s are available for public inspection. So the IRS posts these, and they're also posted to sites like GuideStar and Charity Navigator for the public to be able to review. Like I mentioned, Schedule B is redacted for the public disclosure copy. Organizations also have to make their Form 1023 or 1024 available to the public, which was the application to become tax exempt. And then Form 990s are also available, and you should also make available or at least have available upon request your governing documents, conflicts of interest policies, and financial statements. 990 PF for private foundations. Like I mentioned, they're going to be computing their net investment income, and they pay that 1.39% tax on it. They disclose on their balance sheet the difference between book value and the fair market value of assets. They do have a distributable amount that they have to distribute each year, which is 5% of the fair market value of the assets. If they undistribute the income for one given year, they do have until the end of the following year to pay out that required distribution without the excise tax being imposed. And if there are any excess distributions over the 5% requirement, those do roll forward for 5 years if you're under distributed in a future year. If any payments are due, they are required to be made electronically via EFT-PS. Then back to public charities and 990s. If they have to file the full Form 990, or they can file one of these shorter Form 990N or EZ. So the 990N is an e-postcard. It's for organizations that are smaller in nature, normally less than $50,000 of gross receipts, which is an average of $50,000 over the preceding 3 years. They can file this short form e-postcard with the IRS.
And just to jump in really quickly, this e-postcard maybe takes about 5 minutes to file. So if you can qualify to do the 990N and make your life much simpler, or if you're a brand new organization just getting started out and you don't hit those gross receipts threshold, this is a much better option that you might want to consider.
And then if you're a little bit larger with gross receipts less than 200,000 and assets are less than 500,000, you can file the EZ, which is just a 4-page short form with condensed financial information. If you don't qualify for either of those, you have to file the full Form 990. And then there are some other organizations like donor advised funds and hospitals that have to file the Form 990 no matter what. So those are just some different options if you have a smaller organization or you're just starting out. And to the point about just starting out, Schedule A, you do not have to complete for the first 5 years that your organization is in existence. So you do have 5 years to ramp up your donations and your program services before that 33 1/3% test comes into play. Okay, now some best practices. So we'll just kind of talk through some different topics here that are related to tax-exempt organizations, bringing up some donor consequences about why your donors would care if you're classified as a public charity or a private foundation. They get some different AGI limitations based on who they're contributing their assets to, based on cash or capital gain property. And corporations are always subject to a limitation of 10% taxable income for their contributions. When you receive gifts, we'll talk about some substantiation requirements here. So for cash gifts, you should be giving a letter to your donor for contributions over 250 that states the details of the contribution and that no goods or services were provided so that the donor can go and report the donation on their tax return. For any non-cash gifts, there's some different rules on what the organization does with that property. If they dispose of it within 3 years, there is an additional tax filing, the Form 8282. It must be filed within 125 days, and you need to notify the donor that you disposed of that property within the 3 years. If the property is over $5,000, you do have to get the donor has to get an appraisal completed. The organization, the donor, and the appraiser signs off on that, and the donor needs it for their tax return to take the deduction. And again, the deductions are only tax deductible if there are no goods or services provided. So they just get the deduction for the amount over the fair market value of any goods or services that were provided.
That comes into play if you have your silent auctions or your fundraising events where people are donating items. You need to be careful when you send those disclosure statements back to the donors that it's really just the excess above what the good costs. That's their donation amount.
Yep. Okay, now a couple of reporting changes that have happened in the past couple of years around management fees. So if an organization uses a management company, they are still required to disclose that compensation to the management company as if the organization was the one paying them and not the management company. So this is reported on part 7, section A, column D. There we go. And should be reported, if it's a related organization, it's reported in column E. So you do report that as if the organization was the one paying the management company, paying that CEO for hire or CFO. The IRS is just increasing the scrutiny over compensation and really understanding who's being compensated by these nonprofits. Some state considerations. Most nonprofits are not exempt from Nebraska sales and use tax. So if you have any auctions, out-of-state purchases for use tax, anything like that, you still might have a state and local tax filing. Excuse me. Form 13 only needs to be filed if you are purchase items for resale. So just something to keep in mind if you do have any sales that might be subject to sales tax. If for for-profit, you're not just automatically exempt from those as a nonprofit.
And that Form 13 is a Nebraska form. It's not a federal form. That's your state form to try and get exemption from sales tax. But that really only applies to nonprofits that are selling items for resale. It's not just because you're a nonprofit, you're exempt from all taxes. Typically, you will still be subject to sales tax.
And then the Nebraska property tax credit, if you're paying real estate taxes, you are also required, or you are also eligible for this property tax credit, which is a portion of the taxes paid can be refunded. It will be going away in the future, as Nebraska is changing how they're going to be charging property taxes. But you can file a Form 1120N if your organization is a corporation, or a 1041N if you're classified as a trust, and you can claim that property tax credit. And you could amend prior years as well if you paid property taxes in the past and wanted to try to claim that credit. So then speaking of property tax, if you do qualify to be exempt from that Nebraska property tax, you file the Form 451, which the full long form 451 is due every 4 years. This year is one of those years, so it is due as of 12/31/2024 for next year. And then for the 3 years in between, you can use the shorter form 451A. So make sure that if you have a property that you're using for your exempt purpose, you're filing that Form 451 by the end of the year. And then now we'll get into some more exciting topics. First one being unrelated business income tax, or UBIT.
And as a side comment here, when we sent our survey last year for our presentation, this is the most requested topic that people wanted to hear more about.
So we'll dive in here. So UBIT is income from a trade or business. So this is going to be where you have a profit motive, like a true for-profit entity, an activity that is not related to your exempt purpose, but truly is to create a profit. These are the 3 tests here that they look at for whether or not UBIT is UBIT activity. So again, it's trade or business, and then is that trade or business regularly carried on? And that could be seasonal as well, or if you do like rent out a parking lot every Sunday or something to that effect, it's still regularly carried on even if you aren't doing it every single day. So just looking at that regularity. And then is the UBIT activity is not substantially related to the organization's exempt purpose. So you can't have a business activity and you say, well, all these funds are used for our exempt purpose. It has to be related to the exempt purpose and its nature, not just that we're using the income to carry on our exempt purpose. And I'll kind of let Dan jump in here if he wants to add some more context as well.
So a few comments as we get into these unrelated business income slides. Some things are good to keep in mind. Most of this is all developed through IRS case laws and case rulings. There's not a lot of hard and fast rules here, but what you see here is the 3 big tests, and you have to meet each and every single condition. So if you're not a trade or business, you're okay. If you're not regularly carried on, you're fine. If you are substantially related to your exempt purpose, you're fine again. All 3 of those factors need to be met. And we have a litany of different cases from the past that go into it. But our sub-bullet points there are really the big things to keep in mind when you're thinking about trade or business. Are you trying to make a profit? Would it be unfair competition for some other taxable business? And now you come in and you don't have to pay taxes. Does it give you an unfair advantage in the marketplace? How long are you doing these activities and how regular are they going on? And the other thing that comes up a lot is just because you're using this as a fundraising mechanism to get funds to the organization so they can carry on their activities doesn't mean it's exempt purpose. Exempt purpose truly means it's tied to your activities. It's not just a way to generate more funds for the organization.
So if you do have UBIT income, it's going to report it on the Form 99DT. It's going to be activity that's outside of the exempt purpose, like we mentioned. So some things that you might be doing that would not constitute UBIT are going to be things like a bake sale, where activities are performed by volunteer labor. If you have things that are carried on for the convenience of your members, students, or patients, like a hospital cafeteria. If you have a thrift store and majority of the merchandise is donated. And then if you have rents and royalties or investment income, none of these would qualify as UBIT. So unless the one caveat is the rents, you can see there, if it's debt finance, that would be a UBIT activity. So if you have any of these types of activities going on, those would not be considered UBIT and you would not have the 99DT filing. With investment income, like I mentioned, 990s public charities don't have to pay tax on it, but a private foundation would. Therefore, it's not UBIT income. So common examples of UBIT: advertising, unless you meet some sponsorship exceptions. If you do have that debt finance rental income, that is UBIT income. Any pass-through income, so if you have an investment in a partnership or closely held S corporation through your tax-exempt organization, that is considered unrelated business income. If you have multiple investments in partnerships and you own less than 2% in each of them, you can just report that as one activity on the 990T Schedule A instead of multiple different activities. And then gift shops with unrelated items to your exempt purpose. So if everything in your gift shop has to do with your exempt purpose and what the organization is doing for the community, those would be exempt. But if you're selling anything outside the scope of that, they would be considered taxable. UBIT deductions, you get $1,000 per organization just right off the top as a deduction against your UBIT income. That is not against each activity. If you have multiple different UBIT activities, it's just one per organization. You can deduct any expenses that you can directly connect to your UBI. Charitable contributions to other organizations are deductible. And then if you are generating a loss with your UBIT activity, you can carry that forward to offset future UBIT income. But those NOLs are siloed by activity as well. So if you have an income generating activity, you cannot use losses from another activity to offset that income. Like I mentioned, there was a recent update to now each activity is reported separately on the Schedule A for the 990T. Anything generated after 2018 can only be carried forward against that specific activity's future UBIT income. It cannot offset other activities. Tax rate for UBIT is for your corporations, it's the flat 21% tax rate. And then trust, it's a graduated scale up to 37%. So the UBIT tax can be substantial if you have substantial amount of income. And then, like I mentioned, you just get that one flat $1,000 deduction per organization. Some more changes. So qualified partnership interest, like I mentioned earlier, you can report these all as one activity if you made one of two of these tests. So like I mentioned earlier, the de minimis test, if the organization holds no more than 2% of the profits or the capital interest, then they can report multiple partnership interest under one activity, and just net all of that activity together under one schedule. Then there's the participation test as well. If you own more than that 2%, but less than 20% of the capital interest, and you do not significantly participate in that partnership, then you can lump those different partnership interests together as well.
And if you haven't had a chance and you file a 990T and you receive K1s, I would highly recommend going through and double checking to see if you meet any of these de minimis tests or participation tests, so you can lump all your partnership investments into one activity, because it can make a huge difference. Because what we're really trying to do with making it all one activity is if I have a loss in one year, that would allow me to use it up in a future year, hopefully when I have income. Especially when we have to silo activities by activities. If we report all our K1s separately, we've run into situations where that means we have all these losses hung up that we can't use against income from other K1s. And it gives us a bad tax answer. But if you can qualify for these and mesh all your partnership investments together, it really helps even out your income year to year. So you're not really paying as much tax because you have these losses in the past, which you can now use to activities in the future. And from what I've seen, a lot of nonprofits, when they do these partnership investments, are under that 2% threshold to begin with in a lot of their investments. So you probably do qualify. Some people aren't aware that this existed. This has been a change for a number of years, but I would highly recommend taking a look if you've never thought about this before.
Yep. One other thing to mention as well, I suppose, on those partnership interest, there should be a footnote that explicitly tells you what your UBIT income is, what income from the face of the K1 is subject to UBIT. So if you don't see that footnote, make sure you're asking the partnership to provide you that information so you can adequately report it on your 990.
And to dovetail off of that really quick, because I got in an argument with one of our partnership providers here about that. Technically, that partnership is not required to disclose UBTI information unless the nonprofit specifically asks them to disclose. So if you do get one of those K1s and it's just blank for your UBTI information, that code B, I wouldn't necessarily assume that that means you have no unrelated business income. It just means that the partnership didn't take the time to calculate it because none of their partners asked for it. My personal opinion, every K1 you get, if you're a nonprofit, you should be seeing some type of UBTI disclosure on there. And if you don't, you should go back to your partnership and ask them to disclose it on the returns going forward.
Okay, so the IRS, what are they looking at? These are some of the top things that they're looking at right now. You know, typically people like, well, it's a tax exempt organization. What would the IRS come after them for? Well, they're going to go after everywhere where they could get tax from these tax exempt organizations. So one of the things that they're going to look at is UBIT. So they're going to look at your profit motive. Is that rental income debt financed? And it really should be subject to UBIT income tax. Your partnership income, like we were just talking about, are they disclosing to you? Are you picking up the correct amount of the UBIT income? Advertising income, and then sale of merchandise. So I think, Dan, if you maybe have looked into this a little bit more about some IRS cases that they're actually looking at these topics for and what they're going after.
So really, if you see some of the audits that are out there right now, these are their 5 main areas for UBI where they're picking things up. They're taking a look at your 990 and saying, well, it looks like you have advertising income. It looks like you have some partnership investments. It looks like you're selling some goods. How come you don't have a 990T attached to your return? Or you have lots of rental income and you have a large amount of debt on the book. Where's your 990T? These are just things that the IRS is currently looking at that you could run a follow for UBI purposes.
Okay, and then some other things to consider. So if you do have a UBIT reporting requirement and you're filing that Form 990T, you also do need to file the related state income tax return. So it's either going to be that 1120N or that 1041N that needs to be filed with the state of Nebraska. Or if you're in another state, you need to look at that state's reporting requirements as well if you have a state filing. Then they're also required to make estimated tax payments, similar to corporations. So if you do have this UBIT income consistently each year where you're paying tax, you are required to pay in quarterly estimates to avoid that extra interest and penalties. And then There's a couple of publications here that really dive deep into unrelated business income tax and some of the disqualifying non-exempt activities. Like we mentioned earlier, there's not really a bright line with what is a UBIT activity. So if you have certain facts and circumstances and wanted to dive deep into some publications, those two listed on this slide are some good information.
And I do want to give the IRS props for releasing these two publications. They do a really good job in there, and they go into a lot of detail. They give a lot of examples. They have a lot of case studies. They talk about our 3 factors. Is this a trade or business? Is this regularly carried on? Is this substantially related to your exempt purpose? So if you're concerned if one of your activities really is something that could meet those 3 tests, these 2 publications, brand new, they did a really good job of diving into it, giving you some examples so you can take a look to see, well, does this activity really qualify as unrelated business taxable income? So if there's a note you want to make of today's presentations, I would highly recommend keeping those 2 publications in mind because they are new and they do a really good job.
Okay. And now we have a polling question here. So if you are eligible to receive CPE credit and would like to, just go ahead and complete that polling question. I believe it's a very difficult question. Are you still listening? Hopefully you are all still listening. We're about to get into all of the fun stuff here. And you can see on the slide as well, Reagan's email address is there if you need the certificate. Then hopefully everyone's still listening and we've completed that polling question. And we'll leave it up here for another 30 seconds or so. And Dan is going to start talking about tax updates for nonprofits. And again, just to reiterate, if you have any questions, make sure you put them into the chat and we will answer those at the end of the presentation. So Dan, I'll let you kick off some updates.
All right, and I'm very excited to do so because some years we really don't see that many tax updates in the nonprofit space. It's just more of the same year after year after year. This year, we actually get a few things we can actually talk about when it comes to actual tax updates. Where I want to start is what the IRS said, where their focus areas are for the upcoming tax year. They have a lot of brand new IRS tax exempt agents, and Hannah and I can definitely attest to that fact. When we've called the IRS tax exempt organization line, a lot of them really don't know the rules all that well. And we've had to struggle through a few different things that we would have thought that they would have known better. So just keep in mind, if you do get some type of notice from the IRS, I would be very careful. I wouldn't just pay it right away. I would look into it a little bit more because we ran into a number of different situations where the IRS was just flat out wrong in that case. So I would think very carefully about that because they do have a bunch of brand new agents in this area. The other areas that they were planning to hit, employment taxes, as Hannah mentioned, the IRS wants to go after areas where they can actually get some money from nonprofits. If you have payroll, watch out for your payroll taxes. Unrelated business income, undisclosed compensation to employees or contractors. And the other thing that's a little bit new is they're really starting to target private foundations that are funded by a high net worth individual while that high net worth individual is still alive. So if I have lots of money and I start up a private foundation, they're starting to do more dual audits where they're looking at that individual's 1040 tax return and the private foundation they just set up, particularly when large gifts are involved. I want to talk a little bit about the Tax Cuts and Jobs Act sunset. This is going to happen by operation of law on 1/1/2026 if no other tax change happens. It was built into that original law. One thing that can impact nonprofits on the individual donor side is this change to the standard deduction. We've had a number of years now where it's been an increased standard deduction. And now, assuming the sunset happens in 2026, that cuts down to about half. Less of a standard deduction, which means more people might start itemizing again. And I put that statistic in there where when this first came into play and the standard deduction was doubled, charitable giving went down by about $20 billion a year. So the hope is potentially with that standard deduction being cut in half, maybe more people will be inclined to itemize their deductions going forward. Likewise, on that itemized deduction schedule, we've had a $10,000 limitation for my state taxes for the last number of years. That has also prevented a lot of people from itemizing their deductions. When the sunset happens in 26, that limitation is gone, And a lot of donors that had much higher state taxes that they were paying are going to be itemizing their deductions. And now they might think about making some charitable contributions for the tax benefit because they're already going to have to itemize based on how high their state income taxes were. The other thing to mention is the tax rates are going to change as well. It's going to go back to what the old tax rate are, which is going to be a higher individual tax rate. And with higher tax rates, more people might be inclined to give to get a charitable deduction. So here are some of the things slated to happen 1/1 of 2026 on the individual donor side, which could impact nonprofits and how much people are willing to give. Now, I put a question mark at the end of this because with the most recent November elections and how things are shaking out, one of the agenda items for the incoming president would be to extend all the Tax Cuts and Jobs Act provisions from 2017 going forward. So we might not actually have the sunset I was talking about where a lot of these tax provisions expire. We could be in the same tax rules we're in now, which I would be very thankful for. We won't have to learn a whole bunch of new rules. So I would keep in mind that looks like more than a good chance that what we have now is going to stay there and the sunset might not actually happen and all these provisions might not actually expire. The other proposals I've heard that are out there is this idea of a quote unquote American university tax, where my large universities are going to be subject to an excise tax on their endowments. There's already an excise tax on large university endowments right now, but that would increase the excise tax even further. Other things that have been mentioned, which could have an impact on nonprofits, exempting Social Security taxes from income tax, potentially offsetting some of the income taxes with tariffs, which would mean lower income taxes overall, and then a change to the corporate tax rate. Could stay at the 21%, or there's also talk about dropping it to 15% if you have domestic production activities in the United States. So all these other factors at play, which could impact charities. There hasn't been anything said directly about nonprofits, and if there's any plans to change the nonprofit tax itself. But here are some other different options that are out there, which could be an impact. Probably good to know that are going on. See if it impacts your donors. One thing that came about during COVID was this whole $300 non-itemized charitable deduction. So in general, if I'm making a donation to a charity, I need to itemize my deductions before I can even see any type of charitable tax benefit for it. There was a period of time where we had this $300 charitable deduction. You could claim it without having to itemize your deduction. And if you take a look at a quick statistic there, giving was up by about 7.5% individuals when we had that in place. There's been a number of bills over this last year to maybe try and get that back in place. But what I want to mention is I don't really think that that's going to happen. If you look at some of the things that the Joint Committee on Taxation put out there, they think it's going to be way too costly. And then some other think tanks out there say most people already give at least $300. So we're not really going to motivate people to give even more. All it's going to do is just be more costly for the government. So there's a lot of things working against trying to get that $300 non-itemized charitable deduction back on individuals' tax returns. I think it's kind of a shame, but I do want to bring it up that this idea probably isn't going to go anywhere anytime soon. Last time when we did this annual update, we spent a lot of time about the new donor advised fund, proposed regulations, what's going on there. It's been a while since I ever mentioned anything. I want to keep it pretty brief for this time. As we talked last year, it was mostly definitional updates, but it's been over a year now and we haven't had anything more on this topic. We thought maybe we might get some more information, but things have stalled out for the time being. The only thing that I want to mention with regards to those proposed regulations, because there's one section that's getting a whole lot of pushback, is that under the proposed regulations, my advisor for the donor advised fund can't be the same person as my individual investment advisor. That's getting a lot of pushback. There's a good chance that that's going to be removed. But why this matters is donor advised funds keep growing year after year after year. If you look to see who's actually the biggest charity in the United States right now, it's actually Fidelity, because they have all these donor advised funds accounts. So this would be a big hit to them because now Fidelity can't manage the donor advised fund and the donor's individual's personal assets. They would have to split off if this proposed regulation stays in place. But like I said, there's a good chance with the amount of pushback and comment letters they're getting that that's not actually going to happen. More to come on donor advised funds and the regulations. There hasn't been a whole lot that happened this year on the area. Okay, Corporate Transparency Act. Hopefully everyone has heard about this in some shape and form. This is a new legal filing that happens with FinCEN, where you basically have to disclose the ownership of your business. However, it's written broad enough where certain nonprofits might be hit as well and might need to file one of these reports. And typically, if you are a pre-existing entity, you have until the end of this year to file the report, and new entities have a much shorter time period to actually file. The good thing is there's a list of exceptions, and there is an exception if you're a 501c3 organization, which would be your public charities and your private foundations. You would not have to file one of these beneficial ownership reports. You do not have to go on to the FinCEN website, don't have to register. Likewise, if I'm a wholly owned subsidiary of a nonprofit, I wouldn't have to file one of these reports. What I want to caution you though is, say I'm a 501c4, say 501c5, 501c6. From reading the regulations myself, it's unclear if you would be actually covered and you wouldn't have to file. There's a good chance you might actually have to file if you're not actually a 501c3 organization. I would go out, I would talk to your attorney and follow up with them to see if you might need to file, because from the way I'm reading it, it's only the 501c3 organizations that are truly exempt. Other types of nonprofits might still need to file. And you might be asking yourself, well, that doesn't make any sense. I thought the whole purpose of these reports were to disclose the owners of these organizations. As a nonprofit corporation, we don't have owners. Unfortunately, the rules are a little bit more nuanced, because when it talks about beneficial owners, they can sometimes bring in your key officers. So if you're a key decision maker or a key officer, you might have to report on one of these reports as being a beneficial owner of the organization, even though there's no quote unquote legal owners of the entity. So just be careful if you're not a 501c3. And even if you're a 501c3, the rules are written a little weirdly, in my opinion, because if you ever lose your 501c3 status, technically at that point in time, you need to go in and file one of these Corporate Transparency Act reports, a beneficial ownership reporting report. Likewise, if I'm starting a new 501c3 organization, typically I need to file one of these reports if I do not get my exemption letter in time. And the IRS has been a little delayed with those exemption letters. So if I am a new 501c3, typically I'm not going to get that exemption letter in time. So I need to file one of these beneficial ownership reports for a brand new 501c3 organization. In the future, I won't have to. But for the first year, the way the regulations are written, it looks like new entities would have to file if they don't get their exemption certificate in time. Other thing I want to mention on the tax update side of things, one thing came up during this year during a congressional hearing as to, are we going to make any big changes to the Form 990 itself? So there was a hearing on it. They made some talks and some comments on it. The things that came out of that hearing, possible revamps to the Form 990, there was a lot of call for additional details on grants and who your grant recipient is. So we have that Schedule I on the 990 where it talks about gifts over $5,000 to other organizations or individuals. And they want that a little bit more fleshed out to give more detail on what was the grant and how it actually benefits the community and how you're proving that that is tied to your tax-exempt status. They also want more detail if you're giving any in-kind gifts or anything that's not cash. If you're giving property or potentially even services to other communities, they want more detail on what's going on in that area as well. These are not finalized. I haven't seen any proposals to actually change the 990, but this is what Congress was talking about earlier on this year as potential changes. The other areas that they were talking about where we might need more disclosure is Schedule F, talks about your activities outside the United States. Right now, it's pretty bare bones. It would make that a little bit more detailed. And this whole concept of fiscal sponsorships, where I'm a nonprofit and I hold money for another organization, they would like more disclosures related to that type of relationship. Again, none of this is final, just some ideas that are out there in case you hear anything. I do want to mention that a lot of this hearing was focused more on stopping money laundering organizations and terrorist organizations. They were really concerned about terrorist organizations starting a 501c3 and funding not very good activities. And that's where all these other different topics came out about, well, we need more details on grants. We need proof that's for the community. What are you doing outside the United States? And are you holding funds for other organizations? So that did come about. I'm not really seeing any potential changes, but that has been in the news. So lastly, what I want to talk about is just some overall industry trends. I looked at a number of different reports over the years. And I thought it was just interesting to talk about, well, what are we seeing in the nonprofit space overall? Just how are things going? So the first thing I want to talk about is from the IRS's point of view, where are we standing at? We're close to almost 2 million tax-exempt entities on the IRS's official list. Now, when you break it down a little bit more, only about 400,000 actually file a full 990, where they have more than an insignificant amount of assets or revenues for the year. And then only about 80,000 file that 990T to disclose UBIT information. For the last fiscal year, there was about $136,000 applications for new tax-exempt entities. And if you look at the actual audit rate for audits in the nonprofit space, there was about 2,500. And if you go back 1 year, it was only about 1,500. So you can probably do the math yourself to see, well, we have 2 million organizations that are out there, but we're only seeing about 2,500 audits each year, and we're getting about 140,000 new entities each year. So that's where things sit with the IRS. That's their snapshot of where we're sitting for tax-exempt entities. One report I brought up last time we did this was the Giving USA report. I thought it was pretty interesting. So here's our updated report for 2023, but it gets released in June 2024 about where overall charitable giving is at. So if you look at 2022, we had 546 billion of charitable giving, and that jumps up to 557 billion of charitable giving for 2023. One thing to note though is that while it's great that we see an increase, charitable giving was actually down overall when you adjust for inflation. If you use an inflation rate of about 4%, charitable giving was actually down from 2022, even though the dollar amount increased. The only type of gift that actually outpaced inflation was bequest. And a bequest, for those that might not know, is if I pass away and I give money through my estate to a charity, that's bequest. So when I die, giving money to another charity. That's the only type of gift that actually outpaced inflation in 2023. Otherwise, when you adjust for inflation, charitable giving was down overall. And if you look at where those donations are coming from, we see another decline this year of donations coming from individuals. It dropped down to 67.2%. And we keep seeing a shift of more donations coming from corporations and even more and more donations coming from foundations. And when I'm talking about foundations, that does also include your donor advised funds. So more and more gifting through those vehicles than opposed to outright individuals. On the corporate side, why they say we saw a jump on more corporate giving is a lot of these matched gift programs where a corporation will match someone else's gift or match an employee's gift. That's where we see a lot more of a spike in the donations coming from corporations. If you look to see the industries that had the most growth overall, nonprofits related to education had the most growth at about 6.7%. And if you look at your overall top 3 sectors, religion counts for 24%, human services for 14%, education for 14%. One thing that I found very interesting, when you look at the religion portion, 24% being the largest. If we look back 40 years ago, that number was closer to about 2/3. And over the last 40 years, religion gifting tends to keep decreasing year after year after year after year, and these other sectors keep increasing. And in reality, religion gifting actually dropped about 1% compared to 2022. It was about at 25% last year. So religious organizations keep seeing a hit year after year about less giving coming their way. And as you see there, education had the most growth this year. One thing that I found as good news is there were some concerns in the past when you look at these reports that you had a lot of mega donors funding a lot of organizations, where it was just huge gifts coming from small people to keep organizations around. This year, we did see a decrease in super large donations from large donors. Mega giving overall was down. So we do see more donations coming from regular people in smaller amounts, as opposed to just few really large gifts. The Tax Foundation also released a report of where we sit for charities. And what they came out and said is that if you actually look at the US nonprofit economy, that's about 15% of the US GDP. And if you translate that over, Charitable activities would be the 5th largest country in the world for GDP for what all goes on. There's over 8 trillion in assets that are managed by different charities in the US. One thing that caught me a little off guard too is if you actually look at the revenues of charities, only about 12% come from donors, such as private foundations, individuals, corporations, and the other 71% tend to come from program services. So charities are actually running and doing some type of activity. And just so you know, hospitals inflate that number a lot because hospitals make about 55% of that program service revenue. But if you look at overall nonprofits, charitable donations are a tiny portion compared to the activities actually being run by those organizations. The other thing I found surprising is if you look at organizations themselves, only about 17% of organizations, 501c3s, actually report some type of UBTI. And only about 8.5% of total organizations actually pay some type of tax. So for people that are concerned about UBI, it doesn't really apply to all that many organizations. And even those that have it, most actually don't end up paying any type of UBI tax. So we had a couple of different court cases this year that I want to draw people's attention to because I think it's just good overall to keep them in mind. So one that came up is this whole Buckeye Institute case. And what they're basically arguing is that the Form 990 is unconstitutional, that the IRS should get rid of the Schedule B, where you have to list out your donors' names and their addresses and the amount they gave. They claims it violates their First Amendment freedoms of assembly and association. And last I checked, the case was still ongoing as of October 2024. So it's still working its way through the court system. It would have some pretty big implications if they came out and said, yes, Schedule B unconstitutional, no longer need to disclose donor information. And to give a quick little bit of background on this case about what actually happened. So Buckeye Institute is a tax policy group in Ohio. They were running some projections on Medicaid expansion. They got audited by the IRS, their 990. And from what they saw, their donors got very concerned because the IRS could see the Schedule B as part of their audit. And a lot of their donors started to dry up and stop giving donations to the organization because they were afraid that they might be brought into audits on their personal returns since the IRS can see them as a donor on their Schedule B. And the Buckeye Institute revenues dramatically dropped. So they went to court to the IRS saying, by forcing us to disclose our Schedule B, we had a negative consequence because our donors were afraid to give to us going forward. Even though that Schedule B just goes to the IRS and not to anyone, that's not for public disclosure for 990s. There's still some concerns about what could happen there. But this is a new development because it seems like there could be a chance that Schedule B could just be gone going forward. And that's less record keeping we'd really need to do on the tax side. The other case that's worth mentioning, and maybe you've heard about this one, Looper Bright Enterprises versus Raimondo. The long and the short of this one is the courts cannot defer to agency interpretation of law simply because the statute is ambiguous. And what that somewhat means in plain English is we had this whole doctrine that's called this Chevron deference doctrine, which basically said, if I have a government agency, the courts are just going to let the government agency interpret the regulation. And so long as it's a fair reading of the regulation, we're not going to look into it any deeper. It's not the court's place to get involved and try and re-find out what would be the best interpretation of this regulation. That's now gone. And what it does is it exposes a lot more regulations out there to higher scrutiny and potentially being overturned. Treasury writes the regulations for the tax code. So there could be some Treasury regulations relating to nonprofits, and then particularly in the private foundation space, which could be challenged and could be overturned. The one thing I do want to mention, though, is Treasury is a little bit different than your other federal agencies, whereas in some statutes, they expressly say, let Treasury make the rules for this and flesh these out in more details. So for those statutes and regulations, probably a little bit harder to get some challenges on the tax side, but do be aware that we can see some more challenges to some of these regulations out there, even if they're 40, 50 years old. It opens the door to some challenges on tax regulations that have been out there for a while, because now there's not as much deference to the agency as there was in the past. I haven't really seen anything yet for tax challenges. We thought there could be this whole flood that are out there, but more to come in this area. Keep in mind that we could see some changes to tax regulations. And we are at our question slide. And I know we had a couple different ones pop up in our chat coming up. If you have any other questions, please send those to us right now. And then I will try and address some of these with Hannah for the ones that we've got so far. So the first question we received is the current year's income of the organization or the donor? And I might need a refresher on that one because I think that was during Hannah's section near the very beginning.
Yep.
Talk about.
I can take that one, Dan. So I think it's relating to Schedule A Part 3 test. So for the Schedule A Part 3 test, we have the concept of disqualified persons versus non-disqualified persons. And we're going to look at our 1% limitation on the current year income of the organization. So we're going to take that donor's donation, compare it to the total income of the organization. That's going to include your contributions, your program service revenue, investment income, and other income. And it's going to do the 1% limitation for that current year. But then to calculate our 33 1/3 percent, it's going to look at all of the income over a 5-year period. So it's going to take each limitation by year and then divide the public support by the total income to see if you pass that 33 1/3 test. Hopefully that helped, but like I mentioned earlier, Schedule A is quite confusing, and depending on if you're doing Part 2 or Part 3, we have different limitations if we're looking at a 5-year period or just a 1-year period, and then what we're looking at for total income. So if you have more questions about your specific Schedule A, we can follow up after this as well to look at that.
So moving on, we had another question about, have you ever had a customer who claims they're a not-for-profit and potentially has filed returns in earlier years by themselves, but now all of a sudden you determine that they are not really a not-for-profit? So my answer to that is yes, kind of, because what I've seen is organizations that come to us and say, oh, we're a not-for-profit, but what we have done is check them up on the IRS website, and hopefully everyone's aware there's an IRS website out there that you can type in the name, the location, or even the EIN of the organization, and the IRS website will tell you everything that they have on them and whether they're tax exempt. They might not have all the prior year returns, but they will tell you if it's a tax exempt entity or not. So when we've done that and we've checked, what we sometimes have seen is that their tax exempt status has been revoked in the past because they haven't filed their return for 3 years. So in that situation, when we see, oh no, you've been revoked in the past, we see your revocation letter, you're not really a nonprofit. What we have to do is there's whole reinstatement process under Revenue Procedure 2014-11, where you can go back and get your tax exempt status reinstated as of your date of revocation. It's a very costly process. It's not a very fun process because you have to file returns for each year you missed. But there is a way to get your tax status back. If you have someone that says they're a nonprofit, turns out they're not, there's a way to go back and do it. So we had another question come up about what separation needs to happen between an audit firm and a firm that files a 990. Do they need to be separate or can they be the same firm? So they definitely can be the same firm. I know some people that like just to have the separation, just to have 2 different firms work on their work. But technically, I think it works better when the firm does the same for both, when it does both the audit work and the tax work. So the auditors can talk to their tax preparers if any questions come up. And as for some type of separation that needs to go on, I know we need to sign some type of disclosures each year to make sure there's not some type of conflict of interest. But usually it's nothing major. You can't have one firm do both the 990 and the audit work. And I'm not seeing any more questions for this year. It was wonderful having you all here. Like I said, we will be sending out the slides. We will be sending out a survey at some point in time. Thank you so much for your time and attention today.